and had a good lunch. I don't know if anybody else went out to shovel snow during their break like I did, but my name's Rich Basoski. For those of you who have not met me, um, I'm considered one of the senior tax partners at Hassman Weeble. And with me in this afternoon's presentation, Tax Tips for Auditors, is Monty Glanzer, who is one of our rising stars of the auditing department. I did inform Monty yesterday that due to the weather conditions, I cannot guarantee I'll have power or internet capacity during the presentation, and he may end up having to present our topic by himself. And I think that aged Monty 10 years, and I think he may now be one of the senior audit people.
Almost.
So just some housekeeping, which you've probably heard multiple times throughout this morning's presentations. Please maintain your devices on mute. That'll make it easier so we don't hear things like the trash truck pulling up into your driveway or the dogs barking at whoever's at your door. We're encouraging everybody to use the chat function on the sidebar for their questions. We have a fairly diverse set of topics that we want to cover, so we will try to actually stop and answer some of these questions as we go. So we're encouraging everybody to again use that chat function for any questions and maybe minimize any other chatter as well. Open up on that portal your survey section so you can record the code words. Since this is eligible for 2 hours of CPE credit, there'll be 6 total code words. So it might be easier if you can open them up and record those as we go. So with that, Monty, if you want to proceed, and we'll start the program. Oh, and I will tell you that I have found out that neither Monty, myself, or any of our spouses can sing worth for darn. We also have no clever, witty Christmas trivia tips. So we will actually try to go the full 100 minutes with our topic. Hopefully that won't disappoint too many people. So go ahead, Monty.
Thanks, Rich. Yeah, we'll do our best to occupy the full 100 minutes. So again, I'm an audit manager with Hassman Weeble. And like Rich said, we do have a kind of a wide range of topics to go over. And I just wanted to stress this is it's tax topics for auditors, but it's not a remedial class for auditing. But we do, it's just a list of items that we thought were important for auditors to be familiar with. If not, I mean, have a full understanding of, but at least be familiar with. So, because there's a good chance while we're finishing up the audit, we kind of turn around and do the tax return. And so having a knowledge of some of these items is going to be helpful on the preparation side, on the review side, and just being able to communicate with our tax department with any questions that come up, and also the client when we need to kind of ask for information from their end. So some of these topics might be very familiar. Some you might have an idea of what they are. Some might be new. So just kind of briefly going. So common book tax differences, including the recurring item exception. A number of issues related to S corps, calculating basis, and that's going to be touching on partnerships and S corps, and then self-charged interest and rent, going over some common elections, and then concluding with considerations when selling a business. So common book tax differences. So So, I mean, business owners are generally concerned with what the accounting impact of certain transactions are, but they're equally as interested in the impact it'll have on their taxes. And while transactions may be treated the same for both the books and tax purposes, there are various transactions that, due to the nature or timing, will be treated differently on books versus tax. And so the items we'll be going over are generally applicable to partnerships, C Corps, and S Corps. And you're going to find these book tax differences reported on a few different areas, and it kind of depends on the size of the organization. So a Schedule M1 would be prepared, and that's but it could be that if the entity has over 10 million in assets or 35 million in receipts, that an M3 might be required as well. And I think there is kind of like a in between, where if it's above 10 million but below 50 million, the entity would need to report the M1 and part of the M3, but they'd have the option of just opting into completing the full M3 if they wanted to. But taxpayers with at least 50 million, so 50 million or more, would be required to complete the entire M3, Schedule M3. And the basis of accounting for books also makes a difference. I think entities using GAAP will just in general have more differences, book tax differences, than entities using the tax basis of accounting, for instance. And then there are both temporary and permanent differences. So some might be just a timing issue that might reverse down the road, and some might be just differences that won't reverse at all. And you can see on the slide there, your first code of 6. There's going to be 6 over the course of the presentation. The first one is snow.
Yes, that is snow, as in my wife has just informed me that due to her hip replacement, she will never have to shovel snow again. So.
So now we'll talk about just some common temporary book tax differences. I mean, hopefully, I think a lot of these are probably going to be familiar. Probably the most common is going to be depreciation. If the GAAP entity is using straight line depreciation for its financial statements, but then has to turn around and use an accelerated method as prescribed by the IRS, and sometimes a different useful life, it's going to create a difference in the depreciation deduction. And kind of along with that, it's important to remember that there could be a federal difference between federal and state. I mean, we're mostly right now looking at the differences between book and tax, but just don't forget there could be a federal state difference in depreciation, and that probably has largely to do with if the state that the asset is in, if that state accepts bonus depreciation or not. And also with amortization, there could be a difference, most likely because the IRS requires a different amortization period, so it would just be a different amortization each year. And kind of going along with depreciation, any gain loss on the disposition of fixed assets because of different depreciation methods, because of different useful lives, creating a different adjusted basis or book value for books and for tax at the time of the sale of the asset, which means that gain loss would be reported differently. Unless it was fully depreciated, then it would just be whatever gain would be the same for book and tax. increase or decrease in allowance for bad debts. For books, we can use the allowance method for bad debts, and that allowance can go up and down. But for tax, you can only use the direct write-off method. So whenever a bad debt is actually written off in the year is what the deduction could be. So there could be a difference there. So accrued bonuses and compensation. This is an interesting one. So whenever you have accrued payroll or accrued bonuses for that year, if those accruals are paid within 2.5 months after year end, it will be deductible on the tax return for the reporting period. But if they get paid after that 2.5 month period, it would not be deductible. Or if there was if say a bonus of $100,000 was accrued at the end of the fiscal year or the year end, and then they decided, well, that was part of our quarterly accrual, but we're really only going to pay out $75,000, then only the $75,000 would be deductible on the tax return. So there'd be a $25,000 difference. Kind of similar to that is, but looking specifically at accrued shareholder compensation. So if it's compensation that's for the shareholder, it has to be paid by year end to be deductible on the tax return, not that 2.5 month period after year end. It has to be paid by year end. And see, the last item here is just on 263A costs. So section 263A details that the uniform capitalization rules that require certain costs normally that would be expensed for book to be capitalized as part of inventory for tax purposes. And so that whatever that calculation is would be a difference, book tax difference for the year. So this slide is, we're still talking about temporary differences, but this slide is just looking at one specific one. So the recurring item exception is a temporary difference that allows for a taxpayer to deduct certain expenses that are incurred through the filing of the return, which could be through the extended due date of the return. So if it was a 12/31 year end, it could be until September 15th that you get to take those deductions. So in general, an accrual basis taxpayer is allowed to deduct for an otherwise deductible expense in the period in which I think what is called an all events test is met, meaning that there is a liability, such as a signed agreement, and that liability, the amount of the liability is reasonably determined, and that economic performance has occurred. And economic performance is generally occurs when, as the services are or property are provided. And so what the recurring item exception allows is for the deduction in the tax year before the economic performance occurs. And so if that election is made, the recurring item exception, if the election has been made, then the all events test is deemed to have been met if those expenses are incurred within 8.5 months after year end. So the max would be the extended due date. Unless if the entity filed the tax return in June, then you would just be able to deduct those expenses through June. And it, like I said, is a temporary difference. This is for accrual, so it's not available for cash basis taxpayers. So that's an important point. The election for the recurring item exception can be adopted in the initial year or the initial return of the entity, but it can be applied subsequently, but it would require it'd be a change in accounting method. So it would a form 3115 would deem to be required to be filed to make that election change. And the recurring really means that the term recurring is that the expense is expected to be incurred from one year to the next, and so only certain expenses really qualify for the recurring item exception, and the most common examples are insurance and warranty costs. Rich, do you think that about covers that topic?
Yeah, definitely. I think that was well presented. And other than insurance and warranty, we also see it, the recurring item exception for the deduction of taxes, like personal property taxes and some of the company vehicles, or tangible personal property. Very, very narrow application.
Okay, so just a quick, we're still on temporary differences, but it's important. It's really important to remember that temporary differences eventually reversed at some point. Some may reverse in the next year, like my example of the $100,000 bonus, but it was only paid out $75,000. So that $25,000 difference would reverse the following year. But there are some differences that eventually work themselves out over time. And the best example of that is depreciation. So if an entity buys a $10,000 piece of machinery, and for books, it's depreciated over 10 years versus tax over 7 years. I mean, at the end of that 10-year period, both books and tax have had the same amount of depreciation expense recorded. So it's important to make sure that the prior year return is just reviewed so we can kind of make sure that we're picking up on those temporary differences. And an even easier way, I think, to help with tracking the book tax differences is to have a book tax reconciliation work paper. And I do have an example of that, but we'll kind of go through the next slide, which is on permanent differences first. And so that brings us to the second code word, which is ICE. So so go ahead and put that in the survey. And so that brings us to then common permanent differences. So again, most of these items relate to non-deductible expenses for tax. So it's just always going to be something that is going to be different. There's going to be differences, and they won't ever reverse like temporary differences do. So just kind of going through these, generally meals are 50% non-deductible, and entertainment is 100% non-deductible. So those would be differences each year. For non-deductible contributions, I think in general follow the same rules as individuals. So examples of non-deductible contributions would be political contributions, or the portion of a contribution that is for the fair market value of goods or services that were received as part of the contribution. I think probably the best example of that, or an example of that, is the cost of a meal that you paid for it, along with for a charity dinner. So if the ticket was $50, but $10 was to cover the cost of the food, then only the 40 would be a deductible portion of that contribution. The Tax Cuts and Jobs Act gave us employee parking costs as non-deductible. Expenses, and without going into too much detail, it's just there's certain qualified employee parking costs that are considered fringe benefits and are non-deductible if the employee does not include, or if the employer does not include them in the employee's taxable income. And so any penalties or fines are just 100% non-deductible. The dividends received deduction is actually a reduction in revenue and not expense. And this is only for C corporations. So the dividends received deduction allows for a C corp to exclude from its taxable income a portion of the dividends received from other corporations. So if they have an investment portfolio and they own a bunch of stocks of other C corps, then depending on how much of those C corps they own, then there's a portion, I think, probably typically it's going to be 50% if they don't own very much. 50% of those dividends are excludable from the recipient's tax return. So, and kind of the goal there is just to reduce the amount of triple taxation. So the earnings are taxed at the investment C corp level, and then dividends are given to the owners. And so the next C corp, which owns part of the first C corp, they pay tax on those dividends, and then they provide dividends to their shareholders, and it's taxed a third time. And I've already mentioned this, but so unlike temporary differences, permanent differences will not reverse. And so now I will, so hopefully everyone still sees what I'm sharing. So right now it's just an Excel file that is an example book tax reconciliation in Excel. And so I gave this to Kim Martin late, but it is available to download off of the tax update website, where you launch the sessions and download all the other things. You might have to refresh your page, but it is up there now in case you want to get it later. But essentially, it's a work paper that we can roll forward each year, and then we can identify what of those book tax differences are going to be reversing the next year. And so we kind of start with just what the book income is for each year, and that's coming from typically the audited financial statements that we would put together. And in this example, I mean, we have 2019, 2018, and 2018 is the initial year of the company. And so this first section is just these are the permanent differences. So those non-deductible expenses that we just went over in the last slide. And so the total there's it's a positive number, so it's going to be increasing the book income because it's expenses that are not deductible on the tax return. And then the next section is just it's just getting the difference in the book depreciation versus the tax depreciation. And so in this case, there's more tax depreciation. So overall, it's a reduction in the book net income. And probably because it's such a large difference, because of maybe the depreciation methods, but maybe also because of bonus depreciation. And then kind of the similar with the gain loss on the sale of assets. It would just be getting the difference there. And also the same for amortization. And then we get into some of these other items. So the allowance for bad debts, that was on the slide for temporary differences. So for an initial year, it was $420,000 was the allowance for bad debt. And so the tax return, it's only a direct write-off method, and so we have to add back that $420,000. But in the next year, it reverses, and then you add back what the end of 2019 was for the bad debt allowance. And so for every year subsequent to that first year, it's just going to be the net difference. And similar with, I mean, most of these others too, the 263A inventory. So these are expenses that were deducted on book, but for tax return need to be capitalized and put into inventory. And so in each of these reverse the next year with the new calculation at the end of the current fiscal year would be added back. So this is example of the recurring item exception for insurance. So for the first year, it was determined that they had agreement to pay a certain amount of premiums through September 15th after the year end, and that was determined to be $326,000. And so you can see that's a additional deduction on the tax return that wasn't as part of the book income statement. But you can see that it reverses the next year. But then for 2019, we were just taking the net difference of those items. And the final one is just the accrued bonuses. So in this case, it looks like maybe there was $150,000 different in what was accrued on the books and paid in that 2.5 month window, or maybe they just weren't able to pay it all or any of it by March 15th, and so it's all added back because it wasn't deductible. But then it does reverse in the next fiscal year. So again, that's this schedule is available for download on the tax update website. So are there any, I just looked at the chat briefly. It doesn't look like there's any questions, but are there any questions before we go to the next section?
Doesn't look like it.
All right.
Thanks, Monty. So I'm going to discuss for a few minutes some of the issues that we see related to S corporations. How can I tell if my S corporation is a virgin, and why does that really matter? So prior to 1986, a lot of closely held businesses operated as a C corporation. Corporation paid its tax on its own net profits. The income or loss did not flow through to the owners. After the Tax Reform Act of '86, there was a mad rush for C corporations to elect to be treated like an S corporation, which is a flow-through entity. What had changed is that prior to the '86 Act, a C corporation, even though it's paid tax on its profits, could wind down eventually its business, distribute assets out to its owners, and not pay an additional level of tax. So it was a lot of the income was taxed only once, which is at the corporate level, and usually at rates lower than what an individual tax rate was. To give you an idea, when I started practice in 1980, the maximum individual rate was 70%. That's 70%. So by making significant changes where after '86, a C corporation that tried to liquidate or pass through any of its profits to its owners would now be subject to double taxation, once at the entity level when it earned the profits, and then the second level of tax when the profits eventually came out to the owners. So it made being an S corporation a flow through where the income is generally only taxed once very attractive. So go ahead. Well, next slide. So tax geeks in this world like to refer to an S corporation that has been an S corporation effective from day one as a Virgin S. Up on the screen is an example of an S corporation that is not a Virgin, that it at one time, if you look in box E highlighted, it was incorporated in 1985. And in box A is when the S election was effective, 2005. So there was 20 years that went by that it operated as a C corporation before it decided to become an S. So in this case, we would say this is not a Virgin S corporation because of the years that it operated as a C corporation. So why does this matter? Okay. One of the things that the IRS anticipated when they put in the rules to double tax C corporations is that a lot of companies will elect S to try to circumvent that. Again, an S corporation owners only incur one level tax generally. So they came up with the concept of a built-in gains tax, a big tax we like to refer to. Now, the key things are it only applies if you were a prior C corporation. It's the IRS's way of leveling a corporate level tax on appreciated assets at the time that the corporation elected to become an S corporation. So if you were never a C corporation, but always an S, you never have to worry about your built-in gains tax. And I think on the 1120S, if you went to Schedule B, the actual big tax is disclosed on the face of the return. So it is a corporate level tax, and there's a recognition that begins the first year of your S election is effective, and it goes for 5 full years. So if you sell an asset, you distribute an asset that you owned on the date of your S election, again, you were prior C corporation, you have to go through the gyrations to determine if there is a corporate level big tax. There's also built-in losses, which we'll chat about in a few minutes. There basically are 3 thresholds or limitations in determining how much tax that the S corporation may incur during this recognition period. The first is what's your overall big tax when you made that S election. So as we say at the bottom of this slide, it is so important to do a complete analysis and substantiate if whatever assets may be appreciated at the time you decide to become an S corporation, and retain those work papers in your file, because that is going to be your overall limitation, your overall big. So you could have inventory that has appreciated profits in it. That is considered built-in gains. You may have property, plant, equipment that is appraised more than what the tax book value is, goodwill of a business, other intangibles. So it's really important, if depending on the size of the entity, you may have to have business valuations done, appraisals done of the property, plant, and equipment to determine, again, it's as of the effective date what is the potential built-in gains. You may have some built-in losses as well, which get netted. So if you have a piece of property that you paid $100,000 and you've done an appraisal, now it's only worth $80,000, that's a built-in loss, and that nets against your built-in gain. So that's your first limitation, is what is my built-in gain in total. The second limitation is looking at, during that recognition period, asset by asset that is either sold or is triggered. It's easy to sit back and say, okay, I had a piece of equipment, or I had a piece of property that in that 5-year recognition piece I sold, and I have to recognize the built-in gain. But there's a lot of other routine transactions that we don't always think of, like the sale of inventory that you held on the books as of the last day of your C year has appreciation in that, you hope. So that can trigger, when your inventory turns, it can trigger built-in gains. If you're a cash method taxpayer, your accounts receivable have zero basis. So when you collect those receivables, those also will trigger the built-in gains during that recognition period. So it's not just the sale of property, plant, and equipment. Clearly, if you sell a division or you sell the business and it's an asset sale, you need to be worried about things like goodwill, customer lists, any intangibles that a value is put on in that sale. And if you're in that 5-year period, you do need to take a look and see if you have a built-in gain. And by looking at the gain on a property by property basis during that recognition gain, if it's sold at a gain, for your big purposes, it's going to be the lesser of your actual gain or what you calculated as your big at the effective date of the S election. So if Monty helps one of his clients convert to S status, and they, of course, did a great job of substantiating, and they say that piece of real estate in Greene County has $100,000 built-in gain attached. If they sold that property 3 years after they elected S, and the gain realized was only $80,000, you only paid the built-in gains tax on the $80,000. That's the lesser of the actual gain that's recognized, or how much gain is at the time of the effective date. If an asset is disposed of at a loss, you could have a built-in loss, and that's also going to be limited to the amount of the actual loss recognized, or how much you calculated in your built-in losses and built-in gains when you did your calculation. So an example, let's say for that same piece of property for $100,000, it was determined that it was actually, at the time you went S corporation, that it had a built-in loss of $10,000. So you thought it was really worth only 90. And when you sold it, if your built-in loss, if you actually incur a loss of say $30,000 because it depreciated in value, in doing the built-in gain calculation, you're only limited to the $10,000 that you can use. Another example to throw out there is, let's say my built-in gain computation, which I substantiated, was say $10,000, and I sold it for a $10,000 loss 3 years later. The amount that you would take into account in your big calculation for that year of sale is zero. So you don't recognize the $10,000 loss that you thought you had at the time that you went S, because you did not incur, you incurred less than that. But the same token, because you did not anticipate a built-in loss at the time, you cannot offset any of that current year loss in your built-in gain tax calculation. So hopefully that makes sense. So, and then the third, so you look at what your overall big is, and you keep a running total of that on the tax return. So you may have started out with $500,000 built-in gain at the time you went S, and in years 1, 2, and 3, you recognized $100,000 each because of whatever transactions transpired. What would be reflected on your return would be the net rolling forward of $200,000 in year 4. The last limitation, so you got the overall big, you got the actual calculation when you dispose of an asset that triggers it, is you're limited to your taxable income in that year as if it was calculated like a C corporation. So again, the big tax is to basically provide, tax dollars for those C corporations who went S to avoid double taxation. So in calculating how much built-in gains tax you have, you actually have to do a second calculation of your taxable income. You obviously, the face of the return in the K1, you prepared in your normal tax rules, but then you have to do a separate calculation and calculate that taxable income during this recognition period as if you're still a C corporation. So you have some things like if you had net operating losses when you were a prior C corporation, or any other type of tax attributes that were coming in out of the old C corporation, you can utilize those in this calculation as well. So you may very well have a situation where when you elected to be an S corporation, you calculated a built-in gain, net built-in gain over losses, and you disposed during that 5-year period some of the assets that would have triggered that built-in gain. But when you actually do your calculation of taxable income as a C corp, you may not have taxable income in that year. So the IRS says, well, you can't just avoid paying the big tax because that year you have a loss. So they require that in any year that you had a taxable loss limitation, i.e. below zero, the big that you calculated for that year carries over to the next year. So in year 1, if I have a $20,000 built-in gain, but I have zero taxable income or less, I don't pay any big tax, but that $20,000 gain carries over into next year's calculation. So it is quite possible that you can outrun paying built-in gains tax. In the first 5 years, either depending upon the economics of your business or careful tax planning, you may be able to create a taxable loss as if it was a C corporation. And once you get outside the 5-year period, recognition period, generally you would not have to recognize any of that built-in gain. So years 1 through 5, you got a loss, even though you had built-in gains triggered. You get to year 6 and you have income. So what? The built-in gains tax generally goes away. Now I say generally because you have to be careful of installment sales. If you had any installment sale obligations when it was a C corp or any new ones that you incurred from sales during these 5-year period, you cannot push out the installment payments beyond your 5-year recognition period to avoid paying built-in gains. So you can't manipulate your taxable income by pushing out installment obligations beyond the 5-year period. So in effect, the installment sale period can potentially go beyond 5 years for recognition. So if I was a C corporation and I didn't pay tax on that installment obligation that was outstanding when I became an S, and if the first payment is not due to year 7, the IRS says tough. Even though you're outside of your 5-year period, we are going to, in year 7, make you pay built-in gains tax. So just the takeaway is you can hopefully carefully plan for this recognition period. However, the use of installment sales, you're not going to be able to avoid your big tax during that. So again, going back to the importance of having appraisals done, business valuations, what have you, to substantiate. It's much easier to have to determine what your built-in gain was in year 1 when you elected status than in year 5 when you sold something and you know that you should have a built-in gain and you have to go back and try to figure it out. Plus, this if the IRS ever comes in and questions your calculation, if you can pull out appraisals and other documentation that proved your calculation of the big tax, I've not seen any instances where the IRS has questioned your big calculation. It's the instances where you've not done your homework up front, you sold something, perhaps you showed a very low big when you eventually sold it, and the IRS comes in and says, let me see your documentation, and you have nothing, then you're really at their mercy. They're going to determine what your built-in gain is. So again, substantiate whenever possible. So before we go into other S corporation issues, hopefully most of you were aware of the built-in gains prior to this session. The takeaway is it's only applicable if it was a C corporation initially, and that generally it only is an issue the first 5 years of the since it became effective. So if we don't have any questions on that, Monty, we can go to the next slide then. So accumulated earnings and profits. Again, this is a concept that originated with C corporations, and it really can cause some significant issues or problems for S corporations that at one time were a C corporation but converted to S status. One way I like to look at it is that your accumulated earnings and profits approximates whatever positive retained earnings you had as a C corporation. And that approximates earnings and profits, but the calculations are much more complicated. But since the balance sheet either on the financial statements or reported on Schedule L on a C corporation is your normally GAAP method of accounting, that more closely resembles earnings and profits than tax retained earnings. So again, you can look at the last year that you were a C corporation, and that should approximate if you had any positive earnings and profits. Another way I like to do is, even if I don't have access to that, is that C corporate return is I compare the retained earnings on an entity on their balance sheet, and I compare that to AAA, which are your earnings, net earnings in your S corp years. And if the retained earnings are more than my AAA, it at least triggers the idea that I may have accumulated earnings and profits. And again, as we did a little bit earlier, looking at page 1 of an 1120S, you should look at almost every time that you work on an S return, just to refresh your memory, looking at the date incorporation and compare it to the date of the effective S election. Because again, this is a mute discussion if you were never a C corporation. So three of the common areas that this matters is it can affect the character of the distribution out of an S corporation. It can also trigger a excess net passive income tax at the corporate level. At the S corporate level, again, we just got done talking about a built-in gains tax, which is a corporate level tax. This would also be a corporate level tax. And if not carefully planned for, it can actually help terminate your S status. So we'll go and look at the next slide and talk about some of these areas. So again, only applies if you had positive earnings and profits as a C corporation. The general rule for distributions from an S corp is that it first comes out, it's a non-taxable distribution to the extent you had positive AAA, accumulated adjustments account, and to the extent that the shareholder has positive basis in their stock. AAA is a corporate level concept. The shareholders will discuss a little bit later in our slides that has to keep track of their own tax basis. And it is possible that even though the corporation has positive AAA over the life as an S corp, the shareholder may have not been an original shareholder, may have bought their stock later, maybe at a discount, and its tax basis may be lower. So, so the general rule is when the S corp makes a distribution, to the extent you have positive AAA, it's not taxable. However, if you exceed AAA, so then you then have to look, did I ever have positive earnings and profits? And if I did, it's now a dividend to the extent that you have earnings and profits. And then if your distributions exceed both your AAA and your earnings and profits, then it's a reduction in your tax basis, and it can, depending again, your outside basis calculation could be non-taxable or it could be a taxable transaction. So you're thinking, well, how can this happen? How can we, have distributions that exceed our profits? And again, as Monty pointed out, there could be significant book tax timing differences between the financial statements, which may be more closely related to the economics of the assets and the actual tax basis. So if we have a piece of property that we took bonus depreciation or some type of accelerated depreciation and wrote off the majority of it in a very quick manner, if that asset is eventually sold, it may generate a bunch of tax, and for book purposes, you may not even have much of a gain. However, depending on other aspects. You may have this cash available to be distributed, and that's actually not a great example because you might have you would generate a lot of taxable income by recapture of the depreciation. But it could be situations where the cash flow out of a transaction, usually a sale, or a sale of a division, generates a bucket of bucket of cash that can be distributed, and that would far exceed your AAA. So you have to know that, number one, was I ever a C corporation? Did I ever have accumulated profits? Because you could very well have a surprise when you file the tax return and determine that not only it exceeded my AAA, brought it down to zero, but geez, now I've actually had a dividend paid out to the shareholders that they were not expecting. So again, if you didn't have any accumulator, if I had losses when it was a C Corp, it was never a C Corp, it's not an issue. You cannot have dividends paid out of the entity. So it's good to know to have good discussions with the client throughout the year, and if they anticipate that they're going to have significant distributions to the shareholders, a good question is to take a look and try to project out if it'll exceed their accumulated AAA. So go to the next slide. Before we get into the sting tax, which is another consequence of a S corporation with prior C corp earnings and profits, did we have any questions on the distributions and the ordering rules? And as we as Monty will touch on later in the session, there is an election. Well, I'll get that in a slide or two. So if you're a C corporation and you have excess cash that you don't want to distribute it out to your shareholders, you want to retain that cash in your corporate, because you're thinking, hey, the rates at the corporate level, 21%, is much less than if I distributed this out and they can invest it at the individual level. So there's a concept called a personal holding company, which basically adds a second level of corporate tax. Again, if you're a C corporation, for those corporations that retain and generate a lot of passive type income in the C corporation and don't make distributions out to the owners. What we normally see, and this actually pertains to what we're getting in now, is if there was a division sold or businesses were sold and it was an asset sale. So the corporate identity and shell remained, but it sold the assets or the assets of a division and generate all this cash, and then just turned around and invested perhaps in real estate, perhaps it invested in securities, other maybe interest bearing activities. Perhaps it lent it to related entities and charging them an interest rate. So again, a personal holding company is at the C corporate level and can potentially pay an additional level of tax. So the excess net passive income tax, what we call as a sting tax, uses the same concepts. You were once a C corporation with positive earnings and profits. So you see this trend going here. Bad things can happen to an S corp that was a C corp originally, and they like to be an S corp to avoid all of these extra taxes. If their passive income exceeds 25% of the gross receipts, potentially it'll have an additional 21 level tax at the S corp level. Passive income, rents, royalties, interest income. So you sell a division, perhaps you lend it to a related entity, and you're getting paid market interest. You could very well end up with 25% of passive income exceeding gross receipts. Perhaps you retain some real estate in the transaction and are leasing that to the purchaser. That rental income could very well be passive income. So I've had a couple over my years. All of these have really been triggered by sale of divisions or sale of major part of the operating business, and they wanted to retain the remaining assets in the S corporation or for investment purposes. Go ahead to the next slide. So some things to keep in mind. Your excess net passive income cannot exceed the corporate's taxable income. So even though you have excess net passive income, if you have an overall loss for that year, you do not have to pay any corporate level tax. Keep in mind also that this is not like a bigot or built-in gains. There's not a 5-year recognition period. This net passive income tax, there's no limitation. It just continues as you're an S corp. So the one thing I want to be careful is that if you have 3 consecutive years where you have been in a C corp, you have earnings and profits, and you had net passive income greater than 25% for these 3 years, your S status is terminated, which could be a disaster if you have appreciated assets in that S corporation and you're hoping that at some point when you wind down that corporation, you only have one level of tax. If your S election is terminated, your result is you're a C corporation again, subject to a double tax regime. So the key is 3 consecutive years of having this net passive income problem can terminate your S election. And even though the actual tax calculation, you may not have any tax in a year where you don't have taxable income, for determining if you have 3 consecutive years, you just have to exceed the 25%. You don't have to have positive taxable income in those 3 years. You don't have to pay any net excess net passive income tax. You just have to have the problem for 3 consecutive years. So that is something to look out for if you have a client who is considering selling part of their business, but not liquidating the business, and they're not selling the stock of the S corporation or what have you. So, again, you probably don't want to lose your S election and result back to a C corporation. Before I get to that last code word for this hour, keep in mind, as I mentioned a slide or two before, and what Monty will hit on a little bit in the next hour, there's an election that an S corporation can make where they can, any distributions in a year, they can bypass AAA and treat them to come out of earnings and profits. Now you think, well, why the heck would you want to do that? Because if I make a distribution out of my S corporation AAA, it's generally non-taxable. Why do we want to create a taxable dividend? Well, if you have an instance where you have been a C corp, you have this accumulated earnings and profits, and you're concerned about the net passive income, you can, that years of distributions, you can actually make an election to pay out your earnings and profits. And again, the net passive income tax and the potential 3 consecutive years only applies if you have accumulated earnings and profits. If you've paid out your E&P through current distributions, you solve this problem going forward. So it's very complicated. I can say in my years of practicing, I've only worked with 2 or 3 clients where we thought this was an issue, and we made that election, and they bought bit the bullet and treated as dividends, substantial dividends in year X to avoid this sting tax or potentially 3 consecutive years. So something to need to look out for. Again, as corporations or C Corps have positive retained earnings when they were a C corporation, there could be some transactions that trip you up. So our code word is for number 3 is sleet. I got mostly sleet yesterday. I could have went ice skating in my driveway last night because of the sleet that we got. So good to mark that, and we will move on to the next slide. So we're just going to spend a few minutes talk about an owner's basis. I believe it was David or Helene in our earlier session talked about some changes in tax reporting for the 2020 year for partnerships and LLCs. So, why is it important to track our basis? The obvious ones is it measures our gain or loss on our dispositions. So clearly, if you get distributions out of your S Corp or out of your partnership, you need to be tracking your basis to determine if those distributions are taxable or not. It's a limit for the ad owner's ability to deduct these losses that come from the pass-throughs. Those familiar with S corporations and partnership investments, it's not up to the entities generally to determine if the owner can deduct these losses on their personal returns. It's up to the owner to track their basis to make that decision. It can make a distribution taxable instead of tax-free. We just talked about instances where an example where with the corporation may have enough AAA, but because the owner's tax basis is different, it could actually make the distribution taxable. And in some instances, a distribution of property to a partnership that may generally be non-taxable, or should I say tax deferred, where the partner would take basis in that property at its carryover partnership basis. It may actually make it a taxable transaction if it does not have enough basis in its partnership investment. Let's go on to the next slide. So there are some reasons why it may be important, why it is important. So we talk a lot in the tax department about it. When it comes to a partnership or LLC, you have an inside basis and an outside basis. Generally, when you look at your K1 and your capital count, that is, in most instances, that is your inside basis, but is not your outside tax basis in that partnership. And this is an instance where capital accounts have been reflected on GAAP or some other method other than tax in a lot of instances. And beginning in 2020, we are going to have to do a little bit more work as the preparer of returns and reflect the capital counts now on tax basis. But it's still not a partner's outside tax basis, the capital count. It's a good starting place, but it's not your outside basis. So, your starting point for your basis, basically, how did you acquire your interest? If you made an initial contribution or contributions throughout the life of your investment, that's part of your basis. It was given to you as a gift or inheritance. The values of the inheritance is your starting point, or if it's a gift, whoever gave you the property, whatever their tax basis carries over. Then you adjust it annually. And again, it mirrors your a tax basis K1 capital account in that you adjust your outside basis annually for your share of the profits, the losses, any tax-exempt income, non-deductible expenses. If you put more money in or if you've got distributions out, these all affect your outside basis in the partnership. Nothing new there. Let's go to the next slide. Now, for a partner or an LC member, you have to look at liabilities of the partnership because liabilities affect their outside tax basis. And that's the key difference between looking at your capital account on the K1 and computing what your outside tax basis is. And again, the outside tax basis is what you need to determine if you can deduct losses, if distributions are taxable, if you sold your interest, what is your basis. So your partnership liabilities may increase your or decrease your outside basis, but they don't have effect on your capital account. They are reported, your share of the liabilities are reported on your K1. So for those of you who have worked with myself or others in the tax department, hopefully this will give you a little bit more insight why we quiz you on some of the allocation of how partnership liabilities are allocated to the various partners and reflected on their K1s. If your share of liabilities that's reported on a K1 increases from the beginning year to the end of the year, that's actually considered as if the partner made a cash contribution during the year. It increases your outside basis. So, and as an example is if I looked at my K1 in the beginning of the year, I was allocated $10,000 of the partnership liabilities, but I get to the end of the year, I'm now allocated $15,000. That increases my outside basis by $5,000. Likely the same if I decrease my share of partnership liabilities, then that's treated like a cash distribution and it reduces my outside basis. So it's really important to get the allocation of the liabilities right, because it's up to the various partners to track their outside basis. It's not the entity's responsibility. So this information is important. Just point out, there are other purposes of determining if it's a recourse or non-recourse liabilities. Generally, the owner must have recourse, must have the ultimate risk of that liability, and to be allocated a recourse debt. And if that's the case, it gives them tax basis for deductions. If it's a non-recourse, let's say a mortgage on a real property where if in default, the lender could only go after the property and not any of the individuals, that's considered non-recourse. And even though non-recourse gives you basis for some things, it does not give you basis for deducting losses. Recourse liabilities are again allocated based upon who has the ultimate risk of loss with that loan. If it's a partner loan or a related entity loan, that's easy. If Marty Monty and I are in a partnership, and I make a loan to our partnership for operating costs. Monty did not. I'm the one who's ultimately responsible. If they can't pay that back, I share the risk. I'm the one at risk. Thus, that recourse debt would be allocated to me and should be reflected only on my K1 and would only affect my outside basis. If it's bank debt, you have to look to see if there's any personal guarantees. For those partners who guarantee that debt, they get allocated that recourse debt in proportion to their guarantee. Let's go to the next slide. So just some reminders, your capital account can have a negative capital account, but you still can have a positive outside basis because you have to take into account your share of your liabilities. We see this quite often. Your outside basis should never be negative. So if you have any losses that exceed your outside basis, they're disallowed and carry over. So it does not drive your basis negative. And if you have any distributions that drive your outside basis negative, it only drives it down to zero, and then you have to actually recognize a taxable gain on that distribution. Again, this is a calculation that's done at the individual level, not at the entity level. Go ahead, Monty, next slide. So an S corporation is a little bit different. You get your basis and your stock, which is going to be similar to how a partner tracks their outside basis and their partnership interest, and that whatever you paid for or how you acquired your stock is increased in your S Corp years by any income or tax-exempt income, and your tax basis is reduced by any losses or any deductions. The major difference is that only shareholder loans to the S corporation can give a shareholder basis for deducting losses. If you remember what we just covered, you could have outside third-party lender bank debt up in a partnership or LLC, and I'm an owner of that LLC. I get allocated a portion of that bank debt, and that can affect my outside tax basis. Not so with an S corporation. The S corporation has a line of credit. It doesn't matter if I guarantee that loan, what have you. It does not affect my basis. So my basis is a two-prong calculation for an S corporation. Stock basis, and then if you make any shareholder loans, then those loans will have a separate basis. And once you've reduced your stock basis to zero with losses and or distributions, the remaining loss is applied against your shareholder debt. So if I have a $15,000 loss during the year, and I would first look at my stock basis, which of course we have good work papers at the individual level, and I only had $5,000 of basis in that, it would reduce my stock basis to zero. Then I would go and look and see if I had any shareholder loans. If I had made, if there was $20,000 of outstanding shareholder loans, again, made by that shareholder, then I would be able to deduct the full $10,000, and it would reduce my basis in that loan by $10,000. If I had no shareholder loans, or my shareholder loans were less than the $10,000, then that loss would be carried over until I have income. So suspended losses do get carried over if you don't have stock or debt basis. We'll go ahead and we'll move forward. So net increase is goes to your stock and your debt basis and the amount of income and gains. Net first restore your debt to the extent that you use debt basis in a prior year for losses. Then, again, after you've restored your debt basis, it gets added to your stock basis. Basis in your stock or loans, as we pointed out in the previous slide, cannot be less than 0. It either one, suspends any losses that would be less than 0, or it could be a taxable transaction. Distributions exceeding your stock basis is taxable to the shareholder. And careful that if you have loans that are repaid, but you've used basis of that loan to deduct previous year's losses, you actually can cause a taxable income in that year of repayment if you've not had income to replenish your basis and loans. So there is actually a disclosure on the K1 asking for any repayment of shareholder loans during the year. And that's why they're asking, is for the shareholder to look to see, did I use any of my shareholder loans in the past? And if I did and have not replenished that basis, if I'm paid anything on that, I'm going to have taxable income. So let's quick jump into our fourth code, and that's hail. A lot of us saw some of hail yesterday as well. So if we have any questions from the group, we will move forward. The takeaway, I think, on basis is you really, at the individual level, need to have good work papers to track this, because neither the S corporation or the partnership are responsible for disclosing this to you. So, okay. There can be different bases in different blocks of stock. So if you've bought your S corporation stock at different times, each block can potentially have different bases. Could also be different basis in debt if there's any more than one shareholder debt. So if you've made multiple loans to the corporation, each loan you have to look at much like a silo effect. We talked about the responsibility for tracking your basis. And if you're familiar with an S corporation, there's no capital account. So even though the partnership capital account is not your outside tax basis, it's a good starting point. But there is no capital account whatsoever on an S corporation K1. So hopefully you track your S status, your S basis from day one. So, okay. Major difference between the basis for a partner and an S corp shareholder is the treatment of debt. We've covered that. A partner is allowed to include his or her share of partnership borrowed funds, where an S corporation can only add cannot add borrowed outside money to their basis. There's various basis rules for at-risk rules for determining if you can deduct an item. Obviously, we know about passive activity losses. Everything is calculated differently. And one good thing is that under the qualified business income deduction, the QBI, the 20% deduction, which again is calculated at the individual level, it has no effect on either partnership or S corporation stock basis. So even though you get a 20% deduction, because you had positive income passing through to you, positive QBI, you do not have to reduce your stock basis or partnership interest basis. Okay. And best practices: invest time up front. Good to get a copy of partnership agreements, especially for allocations. Same thing with debt instruments and the underlying guarantees in a partnership LLC determines how that debt should be allocated on the K1 and if it's recourse versus non-recourse. AAA and accumulated earnings and profits, that's a corporate level concept that is maintained at the corporate level, but it's the partner and shareholders' responsibility for their own tax basis. Okay. So I'm going to go through this a little bit quicker. Self-charge interest. This is again related to if you're an entity or an investment entity that is a flow through like a partnership or an S corporation. And what the IRS, or I should say Congress, has allowed is some recharacterization rules where the partner or the S or corporation shareholder has made loans directly or indirectly to the entity. There's interest being paid on those loans that partner or shareholder is picking up on their Schedule B as portfolio income. But the entity itself, when they deduct that interest, it's actually a passive activity to the flow-through owner. So a simple example would be Monty and I own 50-50 in an LLC that owns a piece of rental property. It's a passive activity by its nature. I lent money to that LLC to help make the down payment, and it's paying me interest on my loan. I have to report that interest I received as portfolio income on my personal return. However, the interest that the entity is claiming is just a ordinary interest deduction. And because I'm passive to that activity and I have no other passive income on my return, I don't get to deduct that passive loss. So there's not a really true matching in that case. That the income is being reported by the individual shareholder or partner, but the deduction at the entity level is passive and not deductible by the until a future time when hopefully you will have some passive income. So the self-charge interest rules allow recharacterization of some or all of that self-charge income at the individual level, and to the extent instead of reflecting as portfolio income, you can actually that interest that you receive, you can recharacterize that as passive income, and passive income can be offset against passive losses, so it'll be more of a match. It can happen when there's a direct ownership in a passive activity. It could also apply when there's related entities making loans back and forth. We're not going to get into that. And non-pro rata loans can also cause some issues where if I make more, I'm the only one making loans, but the overall passive losses, like this example I gave, is split 50-50, then that could affect the calculation of how much gets recharacterized. It's not in the, it's interesting. You don't elect in or out of the self-charge rules. They just apply at the individual level. The entity actually can make an election at their level that binds the individual, but they have to make an affirmative election out of the self-charge rules. But it's interesting. They make that disclosure, that election, but it really affects at the owner level. So I can't really see too many instances where you would want to make that election out. Perhaps a owner has a lot of investment interest expense. And investment interest expense is only deductible to the extent you have investment income. And if I have the recharacterization, and I recharacterize portfolio income to passive to give me the passive loss, then it's no longer an investment income, and I may have investment interest expense I can't deduct. I mean, there are instances, but again, it's something that's done at the entity level, but it affects the individual taxpayer. Go ahead, Monty. Good. For the 3.8% net investment income tax, the recharacterization will only applies to interest received from a non-passive entity. So if you recharacterize it for regular purposes between portfolio or passive, it may allow you to deduct passive losses, but for calculating the 3.8% NII tax, you do not get to recharacterize that at all. And the recharacterization, there is a very, very limited recharacterization. It's actually for loans where the activity is not passive, but it's a active trader business. Then you can recharacterize for the 3.8% rule, but it does not apply if the loan is with a C Corp or if it's with a pass-through entity that you receive self-employment income. Long story short, for NII purposes, it really only can recharacterize if you actively participate in an S corporation and you have self-charge interest. So we'll go ahead to the next slide. Self-charge rent, slightly different, but it's something you need to be aware of. We like to think it's heads the IRS wins, tails you lose. What it does is it prohibits the taxpayer from manipulating the passive activity rules. And if you have self-charge rent, that means rental income from a related entity, you can't say take less salary out of that entity, but take higher rent, generate passive income from that activity that allows you to deduct passive losses from other, say, unrelated activities. So just the takeaway is that if for self-charge rent, if you actually have a net profit, passive income from that activity, it's not passive. It's considered non-passive and cannot help you to deduct passive losses. However, if that rental self-charge rent throws off a loss, then that loss keeps its character and is still a passive loss. So the losses can be tied up in your passive activity bucket, and if it's income, it really can't help you. So again, it's heads IRS wins and tails they lose. So let's go to the next slide. So the key is if you're involved with an entity, an S corporation or partnership, you really need to be identify situations where you have self-charge interest or rent. And all you really need to be doing at your level is disclosing on the K1 the amount of the self-charge interest or rent in footnote form. If you're familiar with the owners, you may inquire if there's any reason, especially if we don't do the tax return, if there's any reason that they want the entity to elect out of self-charge interest. Again, maybe they have limitations elsewhere in the return. But other than that, there's nothing else that the entity needs to do other than you need to identify it. So our fifth code word is frozen. Lots of frozen precipitation yesterday. So, and with that, I think we'll go into, and that's the fifth word. If anybody has not been identified all 5 words to date, we can go back over those if you need it. But Monty's going to take it away and discuss some of the common elections that we see on the returns.
Yeah. So kind of just move through this part fairly quickly. so these are common. These are common to all entities. There's going to be an election for the accounting method from day one, and some of these other ones are related to accounting methods. So if there's any changes in that, then the Form 3115 will have to be filed to be able to make those elections. There's an election. An example of the accounting method is that the 263A capitalization rules, and there's elections and how that calculation is actually determined. As we mentioned before, the recurring item exception is an election that needs to be made, that can be made from day one or through accounting method change. And deferring gain from an involuntary conversion, if a client has a piece of property burned down and the insurance proceeds may exceed the basis, then there could be a gain there, but that can be deferred if elected. I think there might be a 2-year period for that deferral. And there's a number of elections regarding the Section 199A the rules, part of which are talking about aggregation, and there's another one about safe harbor related to real estate, rental real estate. And for all elections, I mean, there's some that need to be filed on a timely return. So I mean, return can't be delinquent to be able to take advantage of some of these elections. And some require that the IRS have permission to be able to make a change in future years. But to kind of look at more specific elections to certain entities, for partnerships, whenever there is a change in ownership, there could be associated step up or step down related to if there was a gain or loss in that exchange. And I think that is one election that, I mean, in some elections you only have to make once and it kind of carries forward, and some you have to make year after year. And I think this might be an election that you make once. And then for partnerships, I think it was a number of years ago, maybe 2015, that there's changes in the IRS centralized partnership audit rules. And so there's an election that the partnership can make to opt out of these rules, and essentially that each partner be audited individually with respect to any partnership audit issues, instead of an adjustment being made at the partnership level. And then looking at C Corps, there's election to be able to file a consolidated return. And then for net operating losses, so the CARES Act did bring back that there's a limited window where NOLs can be carried back 5 years. And so but there is an election to opt out of carrying back an NOL and just moving and just carrying it forward. And then also with S Corps, the initial S Corp status is an election that needs to be made. If there is a qualified subchapter S subsidiary, which is an S corporation that is owned by another S corporation, an election needs to be made to receive that status. And Rich mentioned this, there is an election to bypass the AAA account went in the debt distribution order. So you could bypass the AAA account and make distributions out of the A, E, and P. And I mean, that's more of a tax planning strategy. I mean, Rich mentioned one, but there could be also, maybe there's a shareholder has other sources of losses or whatever to be able to offset that taxable distribution. And that might be a reason to take the A, E, and P distribution. And there's also a specific election revolving around when there's a termination of a shareholder's entire interest. There's a general method where you kind of take a pro rata share of the year's earnings or losses. But but there's also an election that can be made that says we're going to essentially close the books on this specific day, and then that is the portion that of the shareholder going out would reflect on their individual return. And
thanks, Monty.
Yeah.
Yep. So I'll give everybody the last code word, and it's rain. A lot of frozen rain yesterday. All right, so I'm going to run through this pretty quick, which unfortunately will not allow us any time to sing any Christmas carols or anything else, any witty poems. So the takeaway is from when an entity, a client wants to sell businesses, you really, as a trusted advisor, want to be involved up front. You want to help the client make important decisions because character matters. Every time I hear character matters, I, of course, like I'm sure all of you, think capital gain versus ordinary rates, right? I mean, that's what character would mean. So how proceeds of the sale of a business affect the seller and how to allocate it could affect how the seller reports that income and at what rates. And the flip side is the purchaser, how it's allocated and agreed upon will affect their write-offs once they've acquired the business. So best practice, you should have agreed upon written sales price allocation versus the various asset classes. That should be part of the purchase agreement or sales agreement. Again, that should be negotiated up front. There is in the year that either you are the purchaser or seller of a line of business. Doesn't have to be the entire business. It could be a division. Both parties have to disclose on Form 8594 how the purchase price was allocated among the various classes of assets. And they also disclose the tax ID and name of the other side of the agreement. So supposedly, the IRS should be able to match them up. So, you as the seller cannot claim that all of the proceeds from the sale were allocated to goodwill, which gives you capital gain and lower tax rate, whereas the purchaser doesn't allocate it to something with a shorter life for deduction purposes. So there is a matching purpose. Let's move on to the next slide.
I think that's the end.
Yes, and then so really there's 7 classes of assets that you should take into account when they're being allocated. The common one, a class 4, is the value put on inventory. Class 5 assets per the IRS is your property, plant, and equipment. Class 6 is any covenants or other intangibles where the purchaser has to amortize over 15 years. And of course, the coveted class 7 by a seller, which is allocated to goodwill. So again, those of you who are familiar with the government form, you have to disclose this information as well as any other side agreements for covenants, leases, whatever. So takeaway, good practice is be involved and work with the client in the beginning. So you're not trying to, at the end, when you're doing the tax return, try to negotiate at that point how to allocate the sales or purchase amounts. Ran through the last couple sections pretty fast, so we don't want to hold you all up because everybody needs a break after this session. And both Monty and I are available. If you want to reach out through your emails, we'd be glad to answer any questions that you have on today's session. So I just want to wish everybody a happy holiday. Be safe traveling